We did actually get a question in Ian through email yesterday, I think, from one of the attendees, basically asking what changes Zurich fund managers have made in their kind of main funds to mitigate against any possible risks next year. So look, that's a really helpful slide, and I think it answers the question.
Yeah, so we're in, again, to try and summarize my answers at times, a little bit more cautious on equities and looking at bonds properly as a live option for the first time in a number of years, I think is the big shift in our mindset in the last couple of months. But I think it's important that while I'm talking about just 2022 or just talking about the last couple of months, that we all just take a breath and we kind of zoom out a little bit and remember why we're investing and why we're investing over the long term. So I know myself and David and Nick and the team, we probably think quite similarly about this, but I think there's just some good long-term principles of investing that are always worth reiterating. As you've probably guessed so far, if you've not met me before, I like complicated slides. So here's another one for everyone in the audience. But what I'm showing you here is the idea of equities in dark blue, bonds in the beige, and then a 50-50 split in the light blue. And if you were to hold equities any time since 1950 in the US over just 1 year, you could have returned 61%. Excellent news, but you could have also returned -43. Okay, so huge spread, huge range of returns when you just hold equities for 1 year. Bonds a little bit narrower, and then the 50-50 somewhere in the middle. I won't go through all these numbers, but the key point to take away from this slide is the longer you hold your investment, two things happen. Firstly, that range of returns narrows. You have more certainty in what you might get, and you'll also see it starts to shift upwards. So when we're looking over 10 or 20 years, there's hardly any instances of losing money, and there's no instance of losing money in the 50-50 portfolio. So I think it's really, really important that the longer we hold our investments for, the more likely we are to have a smaller range of returns, and it's more likely that that's going to be a positive return as well. So whilst 2022 is just happened, it's right in front of our face, it's the thing that hurts right now, I just think it's always worth having a think of some of these slides at times as well.
Yeah, I think particularly as well, if you look at over the last 5 years, Ian, I mean, we've had so many challenges like, COVID, the war in Ukraine. I mean, if there was ever a period to, I suppose, emphasize that long-term investing will, I suppose, get returns for investors, and the market will rebound strongly after large falls, I think, that period probably was it,
Yeah, definitely. And I think, look, COVID was a great example of that. We've had a good start, again, not to focus on the short term, but even the start of 2023 has been positive again as well. Funds are up a couple of percent. So there's always goes ups and downs, but you smooth that return with your holding period being pushed out a little bit longer. And I think this slide as well probably points to that as well, is what I'm showing you in the red dot is the most money you could have lost in a calendar year in European equities. So if you had bought at the highest point in 2022 and sold at the lowest point, the worst possible decision, you would have lost 21% in 2022. You would have lost 5% in 2021, 34% during COVID in 2020. However, you'll notice what I have in the calendar year return in the blue bar is what you actually gained over that year. And what you'll see is the red dot is always lower than the blue bar, which means is if you held it for the full year, you would have returned better than panicking at the low point as well. So I think that it's just it's to make the same point of the last chart in a slightly different way.